In a world where inflation quietly eats away at your savings, where prices rise faster than salaries, and where holding cash feels safe, but actually makes you poorer, there's a truth almost everyone ignores. Cash is not king unless you know how to protect it. Today, I want to show you the math everyone ignores and introduce 5 assets actually safer than cash, not because they're trendy, but because they grow while cash shrinks. When you hold cash, you bite inflation, whether it's 4%, 6%, or even 10% is silently working against you. Imagine saving $10,000. If inflation is 6% next year, your money will buy only $9,400 worth of goods. Do nothing for 10 years and half your wealth is gone. This is the math nobody talks about. Now imagine putting that same money into assets that historically grow faster than inflation, assets that hold value, produce income, or appreciate over time. These assets don't just protect what you have, they expand it. Wealthy people don't store money, they store value. So let's break down 5 assets actually safer than cash, assets that protect your future, your purchasing power, and your growth. Most people believe that keeping cash in their wallet, purse, or even in a bank account is the safest decision they can make. It feels secure because you can see it, you can touch it, and you know the exact amount. But what most people never calculate is how fast that cash is quietly losing its power. Inflation isn't loud, it doesn't warn you, it doesn't send you a message. It simply reduces what your money can buy little by little, month after month. Year after year. Imagine having $10,000 sitting in your account. Now imagine inflation is 6%. On paper, you still have $10,000. But when you step into a grocery store, pay your bills, or try to buy anything meaningful, you suddenly realize your money buys less. That same $10,000 now has the buying power of $9,400. You didn't spend anything. You didn't lose it. You didn't make a mistake, but inflation took it from you silently. That's the danger. Your money looks the same, but its real value is shrinking. The real shock happens over time. Most people underestimate long-term inflation because they never calculate it. If inflation averages even 3-6% a year, and in many countries it's much higher, your money can lose half its value in just 10-12 years. Imagine saving for a decade, only to realize that the purchasing power you worked so hard to build has been cut in half. That is the silent tax nobody warns you about. It's the tax you pay for doing nothing with your money. This is why wealthy people don't keep much cash. Not because they don't have it, but because they understand one truth: cash is a terrible long-term storage of value. Cash is like ice. If you leave ice on a table, it melts, slowly at first, then faster. That's exactly what inflation does. And this is what most people ignore. They hold on to cash believing they are being safe, while in reality they are watching their future shrink without even noticing. Even simple, everyday examples prove the damage. Think about how prices looked 5 years ago: food, fuel, rent, clothing. Everything was cheaper. Money stretched further. Now look at today's prices. They are higher not because goods suddenly became better, but because the value of money decreased. Inflation pushed prices up, and unless your money grows faster than inflation, you fall behind without doing anything wrong. The problem becomes worse when people save money in traditional low-interest bank accounts. If your savings account pays you 2% interest, but inflation is 6%, you are losing 4% every year in real terms. It feels like you are saving, but mathematically you are losing. This is why understanding the real effects of inflation is so important. The number in your bank account might increase slightly, but the value of what you can buy is decreasing much faster. And here's the part most people miss: inflation compounds. Just like investments grow with compounding, inflation also destroys with compounding. What seems like small yearly increases turn into massive long-term losses. This is the hidden math people ignore, the math that separates those who stay financially stuck from those who build real wealth. Because at the end of the day, the danger is not losing money suddenly. The danger is losing money slowly, silently, comfortably, without even noticing, and that is exactly what holding cash does to your future. Dividend stocks are one of the most underrated financial tools for building real, sustainable wealth, especially for people who want both stability and growth. When most people hear the word stocks, they imagine volatility, risk, or the fear of losing money. But dividend-paying companies operate on a different level. These are businesses with stable earnings, long histories, and powerful cash flows strong enough to not only survive economic changes, but to pay a portion of their profits back to shareholders consistently. The beauty of dividend stocks lies in their dual advantage. First, they give you income, a steady stream of cash that arrives whether the market is up, down, or sideways. Second, they provide growth because the stock price itself often rises over time as the company expands. This combination is what makes dividend stocks safer than cash. Cash sits still. Dividend stocks work for you 24/7. Think of companies like Johnson & Johnson, Coca-Cola, Procter & Gamble. These businesses have been paying dividends for decades through recessions, wars, inflation spikes, and market crashes. Why? Because they are built on essential goods and services people use daily. Their profits don't disappear when the economy gets shaky. In fact, some of them raise their dividends every single year, even during tough times. And these increases matter more than people realize. Let's say you invest $1,000 in a dividend stock that pays 4% per year. That's $4 annually. But if the company increases its dividend by 5–10% every year, over time your original investment earns far more than 4%. While inflation rises, your dividend income rises too, meaning the purchasing power of your income stays protected. Cash can never do that. Your bank doesn't increase your savings rate every year to match inflation. Dividend companies often do. Another powerful advantage is compounding. When you use your dividend payments to buy more shares, those new shares also begin paying dividends. This creates a loop of growth that accelerates over time. It's like planting a tree that grows more branches every year, and each branch grows fruit. Over years, that fruit becomes more valuable and more abundant. This is how ordinary people transform small investments into large portfolios. Dividend stocks also provide psychological stability. Even if the market drops temporarily, your dividend income usually continues. You still get paid. That paycheck, like reliability, makes dividend investing feel less stressful compared to other high volatility assets. Instead of worrying about price movements, you focus on the cash flow, just like owning a rental property but without tenants, repairs, or property taxes. Many dividend companies fall into the category of blue-chip businesses. Industries that dominate globally produce consistent earnings and rarely experience financial trouble. These companies have weathered every economic cycle. They focus on slow, steady, dependable growth. They don't chase trends. They build wealth quietly, the same way smart investors do. Most people underestimate the long-term strength of dividend stocks because they only look at the short-term price movement. But when you zoom out and see how dividends accumulate, reinvest, and grow over 10, 15, or 20 years, you realize that the returns often beat inflation, beat cash, and even beat many other investments. This is why so many financially successful people rely heavily on dividend portfolios to protect their wealth. At the core, dividend stocks represent something cash cannot offer: a rising income stream backed by real companies that produce real value. While cash loses power every year, dividend income grows. While inflation steals from your savings, dividend growth pushes your wealth forward. And while cash gives you silence, dividends give you steady, reliable results, even when the world feels uncertain. Real estate has always been considered one of the most reliable and time-tested ways to build and preserve wealth, not because it's flashy or fast, but because it provides two powerful layers of financial protection: long-term appreciation and steady rental income. These two forces work together to make real estate significantly safer than letting money sit idle as cash. The first layer is appreciation. Over decades, property values tend to rise, not because of luck, but because land is limited, populations grow, and demand for housing never disappears. Even when markets experience temporary corrections, the long-term trend almost always moves upward. This is why many of the world's wealthiest families have held real estate for generations. They understand that while cash loses value with inflation, real estate adjusts and increases with inflation. When construction materials, labor costs, and land prices rise, property values rise too. Real estate doesn't just keep up with inflation, it often beats it by a wide margin. But appreciation is only the beginning. The second layer is rental cash flow, a benefit that makes real estate extremely powerful. Imagine owning a property that pays you month after month, even while its value rises every year. That rent is consistent, predictable, and often increases over time. When everything around you becomes more expensive, fuel, food, utilities, rents also tend to climb. This means your cash flow grows with inflation, protecting your income. Cash can never do that. Money sitting in a bank doesn't automatically adjust to rising prices, but rental income does. This dual advantage, value increasing and income increasing, makes real estate a dynamic asset. It works in the background while you sleep. It grows in price while paying you to own it. And even if the property is fully paid off or financed through a mortgage, the tenant's rent usually covers the expenses, meaning the property is building equity for you with someone else's money. This is leverage working in your favor, something cash can never provide. Another factor that makes real estate safer is its tangible nature. Unlike stocks or digital assets, which exist on screens, real estate is physical. It's land, walls, roofs, and structures. People will always need places to live, work, store goods, and run businesses. That fundamental demand gives real estate a built-in value that doesn't disappear with market sentiment. Even in economic downturns, people still need housing, which makes rental properties more resilient compared to other investments. Real estate also offers unique tax advantages in many countries: depreciation deductions, interest write-offs, all of which improve your real return. Cash, on the other hand, gets you no tax benefits and no protection from inflation. Governments don't reward you for holding cash. They reward you for owning assets that contribute to economic activity. Another hidden strength of real estate is its psychological stability. Property doesn't fluctuate wildly day to day. It isn't affected by minute market news or sudden emotional selling. This creates a sense of long-term security. Investors can think clearly, strategize calmly, and grow steadily. Meanwhile, cash creates a false sense of stability. Your balance looks safe, but the purchasing power quietly shrinks year after year. Real estate also serves as a hedge against economic uncertainty. When markets struggle, when currencies weaken, when inflation spikes, property values often remain strong or even rise. Housing is a necessity, not a trend, and because it fulfills a basic human need, it remains one of the most stable wealth-building assets in existence. In truth, real estate's strength comes from its ability to do two things at once: grow your net worth through appreciation and grow your income through rent. Cash can't do either. Cash brings comfort, but real estate brings results. Cash stays the same, but real estate transforms your financial future over time, quietly, steadily, and powerfully. Gold has a unique place in the world of finance, one that stretches across history, cultures, economies, and civilizations. Long before stock markets existed, long before banks or paper money, gold was the universal symbol of value. And even today, in an era dominated by digital transactions and fast-moving financial markets, gold remains one of the safest and most trusted stores of wealth. This is not an accident. This is the result of thousands of years of proof. The reason gold is safer than cash begins with one simple truth: gold does not depend on governments, banks, or currency systems to maintain its value. Cash, on the other hand, can be printed endlessly. When governments print more money, inflation rises and the value of your cash drops. But gold cannot be printed. It cannot be manufactured. It cannot be created out of thin air. Its supply is limited, and that scarcity is what protects its value no matter what happens in the world. History shows that every major currency eventually weakens or collapses in value over time. Empires fall, financial systems change, inflation rises, and political decisions affect the strength of paper money. But through all of that, gold has survived. In fact, it often becomes more valuable during times of crisis. When people lose confidence in currency or the economy, they turn to gold, and that demand pushes its value even higher. Gold is also one of the few assets that behaves differently from the stock market. When stocks fall, gold often rises. When economies slow down, gold usually strengthens. This opposite movement makes gold a powerful hedge, a shield that protects your wealth when other parts of the financial system are under stress. Cash doesn't do this. When crisis hits, cash can lose buying power quickly, especially if inflation rises at the same time. Another strength of gold is its global acceptance. No matter which country you travel to, no matter what language is spoken, gold has the same meaning. It is recognized everywhere as a valuable asset. Currencies have borders. Gold does not. This universal trust means that gold holds value even when the local economy weakens or when a particular currency becomes unstable. If a currency crashes, cash becomes almost worthless. But gold retains purchasing power across borders and across time. Gold is also resistant to technological risks. Digital money can be hacked, frozen, or lost. Bank accounts can be restricted. Markets can be manipulated. But gold, being a physical asset, cannot be erased or controlled at the push of a button. Its physical form gives it a sense of permanence that digital or paper assets cannot match. One of the biggest misconceptions is that gold doesn't grow. While it doesn't pay interest or dividends, its value historically increases during periods of inflation, uncertainty, and currency decline. And these are precisely the conditions where holding cash becomes dangerous. Gold's purpose is not fast growth. It is preservation, stability, and protection. It's the anchor in a world where everything else fluctuates. Think of gold as financial insurance. You don't buy insurance to make money quickly. You buy it to protect what you already have. Gold does exactly that. When the value of your cash is falling, when markets are volatile, when the economy is unpredictable, gold keeps your wealth grounded. This is why central banks around the world store massive amounts of gold. If gold were outdated or unsafe, countries wouldn't stockpile it. But they do, because they know gold retains value when currencies fail. The deeper advantage of gold is psychological. It gives investors confidence because it doesn't rely on promises or systems. It simply exists. It doesn't shrink with inflation. It doesn't disappear during crises. It doesn't rely on the success of companies or markets. It stands alone, strong and consistent exactly when everything else feels unstable. And this is why gold remains one of the safest asset classes. Its value is rooted in scarcity, global demand, and centuries of proof, while cash is rooted in inflation, printing, and uncertainty. Gold stays strong when everything else weakens, giving your wealth the protection cash can never provide. Index funds are one of the smartest, safest, and most reliable investment options available to everyday people. Not because they promise overnight wealth, but because they offer broad diversification, stable long-term growth, and protection against the risks that destroy the value of cash. When you put money into an index fund, you are not betting on one company, one industry, or one trend. You are investing in an entire market, a collection of hundreds or even thousands of companies working together to grow your wealth over time. This diversification is what makes index funds safer than cash. Cash is tied directly to inflation. The more inflation rises, the weaker cash becomes. But index funds are tied to business growth, innovation, production, and global economic expansion. As the world moves forward, companies grow, profits rise, new products are created, and markets expand. Index funds capture all of that growth in one simple investment. The most famous example is the S&P 500 Index Fund, which contains 500 of the largest and strongest businesses in America, tech companies, healthcare giants, energy firms, financial institutions, all included. If one company falls, the others balance it out. If one industry struggles, others rise. This balance is why index funds tend to grow steadily over decades, even though the market may fluctuate in the short term. What many people overlook is the historical performance of these funds. Over the long run, the S&P 500 has delivered average returns of about 8–10% per year. That means if inflation is 4–6% and your index fund grows at 8–10%, you are still building wealth faster than inflation can destroy it. Cash cannot do this. A savings account paying 1–2% interest will always fall behind inflation. But an index fund has the potential to outperform it significantly. Another major advantage is low cost. Index funds do not require expensive management teams or frequent trading. They simply track the market. This means the fees are extremely low compared to other investments. Lower fees mean more money stays invested and continues compounding for you. Over 10 or 20 years, this difference becomes huge. Even a small reduction in fees can result in thousands of extra dollars in your pocket. Index funds also protect you from emotional investing, the fear, panic, and impulsive decisions that cause people to buy high and sell low. Since index funds are designed for long-term holding, they encourage you to stay consistent. You don't need to constantly watch the market, study financial reports, or time your buys and sells. The strategy is simple: invest consistently, hold patiently, and let the market's natural growth work in your favor. Another hidden strength of index funds is automatic self-correction. When companies fail or weaken, they are removed from the index. New, stronger companies replace them. This means the index fund is always holding the top performing businesses of the market. Your portfolio evolves automatically without you having to do anything. Cash doesn't evolve. Cash doesn't improve. It just sits, shrinking in value as prices rise. Index funds also offer peace of mind because they smooth out volatility. Individual stocks can crash overnight due to scandals, lawsuits, or poor management. But an index fund absorbs these shocks because it spreads the risk across hundreds of companies. This makes it far more resilient than cash, which has zero protection against inflation, currency decline, or economic instability. The long-term math is clear. If you invest $1,000 in cash, it stays $1,000 but loses value over time. If you invest $100,000 in an index fund and allow it to grow at a steady rate, it could multiply several times over the years, not through luck, but through consistent compounding. Every dollar grows more dollars, and those dollars grow even more. This simple, unstoppable compounding effect is how ordinary investors build extraordinary wealth. And unlike cash, which weakens every day, Index funds strengthen your financial future by piggybacking on the greatest wealth machine in history, the global economy. They grow as businesses grow, as industries expand, as innovation accelerates, and as markets climb. Cash waits. Index funds build. Cash loses value. Index funds create value. Cash looks safe but quietly sinks. Index funds look steady but quietly rise. This is why index funds remain one of the safest ways to grow wealth long term. They reduce risk, capture broad economic growth, and consistently outpace inflation, something cash will never be able to do. Most people keep their savings in traditional bank accounts because it feels safe. They believe accessibility equals security. You can withdraw your money anytime, check your balance instantly, and feel a sense of control. But what most people don't realize is that traditional savings accounts often offer interest rates so low that your money is actually losing value every year. It's like watching your hard-earned wealth slowly evaporate without seeing it happen. This is where high-yield savings accounts and money market funds come in, two financial tools that give your money a chance to actually grow instead of shrink. Unlike regular accounts that might pay 0.1% or 0.2% interest, high-yield accounts can pay many times more. And while they may not offer explosive growth like the stock market, they provide a crucial middle ground: safety, liquidity, and meaningful returns that can help offset the damage caused by inflation. To understand why these accounts are safer than cash, you first have to understand how inflation works. If inflation is 5% and your traditional savings account pays 0.2%, the real return on your money is 4.8%. You are losing almost 5% of your purchasing power every year without spending anything. The number in your account stays the same, but what that money can buy keeps shrinking. High-yield accounts help close that gap by offering higher interest rates that partially, or sometimes fully, offset inflation. Another major advantage is liquidity, the ability to access your money quickly. Investments like real estate or long-term bonds may give great returns, but they lock your money for longer periods. High-yield savings accounts and money market funds let you earn better returns while still giving you fast access to your cash for emergencies, opportunities, or unexpected expenses. This flexibility makes them ideal for emergency funds, short-term goals, or money you're preparing to invest later. Money market funds are especially powerful because they invest in short-term, low-risk financial instruments like government securities and high-quality debt. These funds are designed to be stable while offering better returns than ordinary savings accounts. They are often used by large institutions, corporations, and seasoned investors because they combine safety with higher yield potential. Unlike cash, these funds generate income in the background, keeping your wealth active instead of idle. The psychological benefit is also significant. When your money earns interest automatically, even if the growth is moderate, you feel motivated to save more. You develop the habit of keeping your money in places where it works for you. This mindset, the idea that every dollar should be productive, is what separates financially successful people from those who remain stuck in a cycle of saving cash that loses value. Another hidden advantage is the compounding effect. Even if the interest rate is modest, compounding makes your balance grow faster than you might expect. Each month, the interest you earn begins earning its own interest. Over time, this effect accelerates growth, creating a snowball of savings that cash itself can never replicate. Cash stays flat. High-yield accounts rise gradually. Modern high-yield accounts also come with digital banking tools, automatic transfers, bill payments, and savings automations. These features help people build consistent financial habits without effort. Instead of letting cash sit in a drawer or a low-interest account, your money gains steady returns through a simple setup and automated deposits. Financial progress becomes smooth, predictable, and stress-free. People often underestimate the power of small percentages. But when you're dealing with money that sits idle for months or years, even a difference of 2-3% can translate into hundreds or thousands of dollars gained or lost. If you keep $5,000 in a traditional savings account earning 0.2%, you might earn $10 a year. But in a high-yield account earning 4%, you could earn $200 a year, 20 times more without any extra effort or risk. That's the difference between stagnant savings and productive savings. And unlike cash, which gets weaker with time, high-yield accounts help your money fight back against inflation by ensuring it grows instead of shrinking. They make your savings more resilient, more stable, and more aligned with long-term financial health. They give you the benefits of liquidity and protection without sacrificing return. They represent a smarter, safer version of cash, one that actually grows instead of disappearing slowly in the background. When you choose a high-yield account or money market fund, you are choosing to keep your wealth moving forward rather than letting inflation silently chip away at it. It's a simple yet powerful shift, the difference between letting your money sleep and letting your money work. At the end of the day, the biggest financial risk you can take is doing nothing. Holding cash feels safe, but safety is not about comfort. It's about protection, growth, and preparing for a future where prices rise, markets shift, and opportunities appear without warning. The real danger is letting your money stay still while the world moves forward. These 5 assets, dividend stocks, real estate, gold, index funds, and high-yield accounts, are not about getting rich overnight. They are about building a foundation that is stronger than inflation, stronger than uncertainty, and stronger than time. They work together. They balance each other. They protect you when everything else shakes, and piece by piece, they transform your financial future. You don't need to be wealthy to start. You just need to start. Even small amounts invested consistently grow into something powerful when you give them time. Because wealth is not built by chance, it's built by choices. And choosing to move beyond cash, choosing assets that work in your favor, choosing growth over fear, that is the decision that separates those who stay stuck from those who rise. Your money is a tool. Make it work, make it grow, make it protect you. Because the moment you stop letting inflation decide your future and start letting smart assets shape it, that is the moment your wealth begins.